Hi everyone, JR with Secure Metals. Time for another precious metals update for both gold and silver. I'll also do an analysis on the Dow Jones as well, and also the US dollar. Today is July 30th, Tuesday at 5:01 p.m. Eastern Standard Time. The market is closed, and as if the scandals are not enough for this administration, now we have to deal with Detroit bankruptcy. Sort of ironic that the Dow Jones is trading at, the market is closed, it's 15,520. It is $84 away from its all-time high, and there's a city filing for bankruptcy here. So very ironic that we have Dow Jones hitting record highs. We have unemployment where it is, and the Dow Jones is currently hitting all-time record highs. Okay, Bernanke did recently state that the economy was recovering at a moderate pace. And what I wanted to do was examine this recovery here a bit closer. Obviously, the housing market has given us a lot of support, and I think anytime, if you've seen any of the Bernanke speeches within the last couple of months, he always points to the housing market and how good it's recovering and how it's been showing a lot of support here for the economy as well. But I think that even though there is a lot of evidence for recovery, I think one of the questions that we have to look at is who's buying these properties, because I'll tell you, there's not a lot of young families, there's not a lot of new families coming into the market and buying properties. And so, I'm looking at this housing recovery and I'm realizing that equity guys, speculators, investors are the ones picking up all the cheap inventory. Obviously, they're looking to take advantage of a moving market. The market is moving. So these guys are looking to buy and cash out on this market. But unfortunately, investors and speculators is not enough for a recovery. These speculators are coming in, they're looking to make $1, and when they see the flat line, which you're probably going to see, at least in my prediction, I think we're going to see a curve in the appetite here for properties. So, I do predict a little bit of a dip here in the housing market. We saw a month ago that interest rates went from 2 all the way up to the high 4s, literally overnight. And that's most likely going to put a lot of downward pressure on the housing market. And these speculators that are coming into the housing market, these guys picking up all these foreclosures at a really good price, they're also not going to want to stay in this market if the market begins to decline. So, yeah, I predict that a lot of these guys are also going to do a lot of dumping as well. Not to mention the inventory that's going to come about, or the inventory that's been coming because of the banks letting go of their foreclosed inventory. Keep in mind, there's a lot of properties that was put on hold, and it was put on hold because the economy wasn't moving. But now that the housing market is moving, now what you're going to see is a lot of banks dumping their foreclosures. They're going to amp up their foreclosures, and most likely you're going to see more inventory. That coupled with speculators losing interest, I predict another marking, and of course higher interest rates. Again, I predict another housing decline. I don't know how deep that decline is going to be, but I do predict I do predict that the housing market is not going to continue to go. And I think the last numbers showed it. As a matter of fact, I do have this article here from zerohedge.com. Of course, if you want to read the full article, I'll have the link below. But again, farewell housing recovery. Housing starts miss most since January of 2007. Permits have the biggest miss in history. In all the noise surrounding Bernanke's rehash of statements made countless times before, today's only relevant data point, June housing starts and permits, was largely ignored. And one can see why. Printing at 836K, the start number was the lowest since 2012, August 2012. The second largest sequential drop down from 928K in May since 2011, and the biggest miss in expectations of 957K since January of 2007. Of course, we have some charts here. And worst permits, which printed down from 985K to 911 on expectations of 1 million headline numbers, just posted their largest miss in history. So again, it doesn't really look like the housing market is going to continue to go higher. If anything, I think we can all see that actually property values actually we're probably going to see a decline in property value again. Now, again, like I mentioned, when you have numbers like this, I think this can open our eyes on what's really going on behind the scenes here. And again, like I mentioned before, when you have higher interest rates, when you have speculators getting out of the market, when you have banks dumping a lot of their inventory back into the market, I think this is just going to equal to lower prices on homes. So I'd be very, very, very careful here with the housing market, at least as of right now. Okay, a true recovery is always based on savings, not speculation. And also, I also wanted to go over unemployment. Unemployment rate at 7.6 last time we saw this. But what the media failed to mention was that that even though we created 195,000 part-time jobs, the back end number here that we normally don't see, which is the U6 number, we actually lost 350,000 full-time jobs. So full-time jobs, so we're losing full-time jobs. You have full-time workers losing jobs. You have gas prices rapidly rising. And so is also, obviously, the cost of living is going to continue to go up higher as well. And of course, let's not forget inflation, okay? Inflation is not the rise in prices, which, of course, that's what they always say, that inflation is, we're not seeing inflation the way we'd like to. And really what they're trying to say is they're not seeing the prices go up the way they'd like to. But inflation is really the expansion of money supply. And inflation leads to higher prices, it's not higher prices. So we've been creating inflation for the last year and a half. We've been seeing inflation for the last year. They've been printing money for the last year, and what we haven't seen is the higher prices. But I think even though they're blaming the high oil prices on inventory, I don't necessarily think so. I really think this is really inflation beginning or I think this is really higher prices beginning to take effect. And I think we're going to see, obviously we've seen a bit of an uptrend here on gold here on the short term. Okay, but ultimately we do expect much higher prices across the board because, again, of all this money printing. Okay, so again, we have a problem with unemployment. We have a problem with the housing market. We have a problem with full-time jobs, and it doesn't really bode well for this economy. All right, Bernanke said earlier this month, obviously last month, he said that we were looking to taper by the end of this year if we see unemployment down to 7%. We saw the Dow lose 1,000 points within a matter of a couple of days. Really, not just the Dow, across the board. Gold took a really hard hit as well. But really, across the board, what you saw was a big sell-off because he hinted that he was going to start tapering at the end of the year. This month, I think he chose his words very carefully, but he did mention this weekend, and I quote, both sides of our mandates are saying that we need to be more accommodating. So it doesn't look too well. There's really no economic progress. And again, he's made it very clear that if we don't see economic progress, we are going to see more printing. This is another good article, and of course the link will be below. Inflation is too low. Are you kidding us, Bernanke? Federal Reserve Chairman Ben Bernanke said this week that inflation in the United States needs to be higher. Yes, he actually came right out and said that. It almost seems as if Bernanke is trying to purposely hurt the middle class. On Wednesday, Bernanke told the press that both sides of our mandate are saying that we need to be more accommodative. So again, if you want the whole article, you'll be able to find the article at the link below. So again, it doesn't look good for the economy. You know, Dow Jones hitting all-time highs. I've talked about this formation. I've been talking about this formation here for quite some time. This is a very scary formation, and I think I showed a couple formations that came together. As a matter of fact, I believe the dollar is also in that formation. And let's I'll visit the formation when we get to the analysis part of the video, but I'll finish up with this here, guys. These guys sound you know, it seems that they're going to continue to print. It's not only seems that they're going to continue to print, but it also seems like they're going to print even more than they're currently printing. So that's a scary thought. But again, it is what it is. And when you have, you know, what's funny, in the Federal Trade Commission building, there's a statue of a man taming a horse, which is really a metaphor. I think I have the picture here somewhere. And I actually have a picture of it right here. And the metaphor is that the horse represents capitalism and the man represents the government, which of course is needed to tame the horse. I think Bernanke and the Federal Reserve have embarked on a very, very, very serious journey, and I think at this point they cannot turn back. You know, they have the pedal to the metal, and it doesn't look like they're gonna lay off anytime soon. And really, in my opinion, these guys are really experimenting with the largest economy in the world. These Keynesians, all they want is control, and all they're doing is just screwing things up. So you know, I say we need to be very, very careful, be very, very well diversified. Look at the highs, look at the lows, pay attention to both, and buy at the lows and sell at the highs. Metals right now trading at $1,300 for gold and under $20 for silver is really a screaming buy. You know, and I urge everyone to really pay attention to what they have out there and really start reallocating and really getting rid of some of those things that are at their highs and start buying and accumulating at those things that are at their lows. But again, diversification is key. Okay, and so anyway, let's go to the technicals here. This is your Dow Jones again forming this formation here, which is a bearish formation. It's called a broadening formation. You guys have heard me say this time and time again. I have another chart here of the dollar. Now again, keep in mind, this is a monthly chart. So these monthly charts take a very, very, very long time. So I would expect, you know, another 3 or 4 or 5 months before this thing, maybe 2 months before this thing hits 16,000. And again, maybe do a little zigzag. But again, within the next year, year and a half to 2 years, I do expect a big, big, big move to the downside. We saw it here. This move was completed in about 2 years. This move also lasted a year and 4 months. It could be that this lasts less, or it could be that it does 3 years. But the whole point is that this is a very bearish formation. The dollar is currently going not on the monthly chart, but on the weekly chart here. On the weekly chart, let me make this chart a bit legible here. And this is your dollar chart here, again forming and actually it looks like the dollar is actually I think last time I did a video, I think it was here roughly. But let's add a line here, and we can clearly see that this is a broadening formation. We have prices getting higher, and also you have your highs getting higher and your lows getting lower. And again, I do expect these prices to continue to go down. We might see a little bit of a jump here, but regardless, this is a broadening formation. It's not a good formation. It's a bearish formation, and I do expect within the next coming weeks, next coming months, for the dollar to go from 81 where it is now to possibly lower, maybe test the 80 range, or maybe even the high 79 range. So because of this formation also, I do expect higher prices on the gold market as well. Obviously they trade in opposite in a negative correlation. Okay, as far as gold goes, so this is your daily chart on gold. As of now, we have just challenged this 38% Fibonacci retracement a couple days ago at 1336. Currently building a little bit of a bullish flag. Okay, anytime you see this at the top of an uptrend, it becomes a bullish flag. If you see it at the bottom of an uptrend, at the bottom of a trend, then obviously it becomes a bear flag. But this might be a bullish flag. A move below this right here, roughly around 1312, 1308, will probably bring us down to the 1280 range, 1277 range. But as of now, we are testing the bottom of this line, so who knows, maybe we'll test the 1333 before tomorrow. On the daily chart here, you can see a bit more clear, a really nice flag right here. So if this is a bullish flag, it'll test this level here, 1385 here pretty soon. But tomorrow also Bernanke is speaking, and my prediction is if he says anything about tapering, we might see the metals pull back we might see the metals pull back to the low 1300s, possibly the 1270 range, like I said before, to test this 23% Fibonacci retracement. On the longer term, now again, stochastics are on the high side, so again, still a little bit more room to go. And again, we see a lot of momentum here. Just a lot of momentum, but we have gotten out of this trading range here. We definitely did want to stay in this tunnel, but as of now, we are no longer in there. We are actually slightly under it. Now we could see this thing pop back up and target this high area here, the high 1300s, or to test the 100-day moving average. Again, stochastics, moving averages, the $20 made that beautiful, nice curve here, which is very bullish for us. We might find support here in this area. And of course, currently targeting the 1409 100-day moving average. If we look at the weekly chart here, again, this weekly chart looks like it is also trying to push to this 20-day moving average at 1397. Above this line here, 1300, which is the 50% Fibonacci retracement. From the October 2008 low. So we could see this bounce from here, come down to 1300 and then continue to go higher. And I say this if Bernanke doesn't talk about a tapering, which I doubt, because again, he made it very clear that he doesn't even want to talk about taper after what happened last month. And we saw the Dow do this. We saw the Dow come from 15.5 all the way down to 14.5. So really, we lost about 1,000 points in a matter of just a couple of days or weeks. If we look at silver now, silver trading in at 1974. Also trading below, just like what happened in 2008, right below. Oops, sorry, wrong fib level here. Coming from this low here. So silver back in 2008 fell right below the 60% Fibonacci retracement before it began its rally. And again, if the Fed continues to talk the way he did early this month, I believe that this is where the rally is going to start, and the rally will most likely finish all the way up here. So I do expect much, much higher prices. Stochastics on the weekly chart, again, trying to move higher, but again, looking a bit confused. On the daily chart here, again, also broke this trend line. This number right here, 1930 is key level. That's the previous low. Again, we want to continue to create higher lows, and we want to continue to create higher highs. As of now, it looks like we are trading sideways, anticipating this FOMC meeting tomorrow. Again, the 20-day moving average kind of curved, but now it's looking like is flat. So we touched the 23% fib level here. So again, on silver, we don't necessarily want to fall below 19. I think below 19 will bring us back down to the low $18 range, okay? So the gold chart looking a bit prettier than the silver chart is. Again, as of now, we are currently testing the 20-day moving average. And of course, the 50 and the 100-day moving average are all above us. Stochastics are pointing down, but if you notice also on the stochastics, we've been finding support here on the stochastic roughly at this level here. So we could see this bounce back up here if we stay flat here, okay? Actually, right here I'm at. So we could see this find support here and continue to go higher. But again, the gold chart looking a bit prettier than the silver chart. And of course, you saw the dollar currently in a very, very steep downtrend. And at this point, we just want to see what's going to happen with tomorrow's meeting. So I don't expect any giant moves between today and tomorrow, but depending on how we see depending on how the FOMC meeting is depending on how that meeting goes is how we would expect price action. All right. The Dow Jones also taking a little bit of a break and trading sideways here for the last almost 3 weeks. And at this point, a fall below 15.4 would most likely bring us down further. But then again, this 20-day moving average is moving up nicely. So again, Dow Jones currently in limbo right now, trading sideways between here and here. Okay, so guys, that's it for today. I will keep you guys updated tomorrow on how this meeting goes, and thanks for joining me, guys. Have a great rest of the day. Bye bye.